Hello friends, I've been discussing about interest on drawings. Interest on drawings. So we have done two things in this. The first was single drawings in a year. First was single drawing in a year. I have told you that you have to just determine the period for which this amount withdrawn is being used by the partner. Okay. Then second case we did was fixed amount is withdrawn at regular intervals Clear? Now we are taking up the third one. It says unequal amount is withdrawn at different dates. That means the amount is not fixed and the intervals are not regular. Okay. At different dates. Clear? So we have two methods to solve this third case. One is the simple method and one is the product method. Now I'll take an example to show you how we'll be calculating the interest on capital under these two methods. Say, I'll take an example that there is a partner X. He is withdrawing money on the following dates. He is withdrawing money on 1st 5 2016, 2000. Then he is withdrawing on 1st of August 2016. He is withdrawing 5,000. Then on 30th of September, again he is withdrawing 2,000. Then on 31st of January 2017, he is withdrawing 6,000. Then last, on 31st of March 2017, he is withdrawing 2,000. Now we have to calculate interest on drawing, right, using the simple and the product method, because the amounts are unequal, the intervals are unequal. Now what the simple method says: rate of interest is 15% per annum. Clear? First we will take up the simple method. Simple method says calculate interest on drawings on each date. That is, calculate interest for every drawing. Like, right? How? Calculate interest on for every drawing, considering that it is the only drawing in a year. See, on 1/5 2016 he is withdrawing 2000. For how many months the money is being used? For 11 months. What is the rate of interest? 15. Being used for 11 months. We'll calculate for 11 months. This comes to 275. Then on 1/8/2016 he is withdrawing 5,000, 15% rate of interest. For how many months he is using? From August to March, 8 months. This comes to 500. Then on 30th of September he is withdrawing 2,000, 15%. For how many months? 6 months. This comes to 150. Then on 31st of January 2017 he is withdrawing 6,000. How many months? February and March, just 2 months. This again comes to 150. And last is 31st of March 2017. Last day of the accounting period. For how many months? 0. Interest 0. Clear? So we have calculated interest on individual drawing considering that it is the only drawing in a year. Okay, now what we will do is we will just add up this interest. It will come to 1075. This is the total interest on drawing. Simple. So this is the simple method of calculating interest on drawings when the amount is not fixed and the interval between the drawings is not fixed. Now let's see the product method. Now we'll see the product method. Now I'll make one table. I'll say date, then amount of drawing, then period for which this drawing is being used, okay, and then the product. Now I have on 1st of May 2016 amount withdrawn is 2,000. For how many months this amount is being used? 11 months. I'll say 11. I'll write here 11. Next, on 1st of August 2016 amount withdrawn is 5,000. For how many months it is being used? 8 months. Then on 30th of September 16 the amount withdrawn is 2,000. For how many months it is being used? 6 months. Then on 31st of January 17 amount withdrawn is 6,000. It is being used for 2 months. Then on 31st of March amount withdrawn is 2,000. For how many months it is being used? 0. Get the product of this amount and period. 22,000, this comes to 40,000, this comes to 12,000 and 12,000. Get the total of this product. This comes to 86,000. Clear? You know the amount, you know the period for which this amount is being used. Get the product of this amount and the period and total the product. Now calculate interest on drawings on this product for 1 month. What will be the interest on drawings? Interest on drawings will be on this product 86,000 into rate of interest for 1 month, because here we have calculated the number of months. We have multiplied with the number of months, so we have got the total drawings, right? And on the total drawings we will calculate interest for 1 month. This comes to 1075. The answer will be the same under the simple method, 1075, and the product method also 1075. Clear? These are two very simple methods. Simple method is calculate interest on drawings on individual drawings, right, and then total it. Product method says that multiply the amount with the period for which that amount is being used and then total the product, and on that total calculate the interest for 1 month. Clear? So this is the case where the amount of drawings is not fixed and the interval of drawings is not fixed. So we cannot apply the average period method here. In the last lecture I told you that average period method can be applied only when the amount of drawings is fixed and the interval of drawings is fixed. Now we cannot apply here. Okay. Now one small point is here that you have to remember. There is a term drawings against profit. Okay. And there is another term drawings against capital. Now what is the difference between these two terms? This is that we are earning profit and we are withdrawing some part of the profit for our personal use, right? We call it as drawings. But drawings against capital means we have introduced the capital into the business and we are withdrawing some part of the capital from the business. So we call it as capital only. Basically what we are doing is we are introducing 1 lakh as capital into the business to start the business, and then afterwards we are withdrawing 20,000 from the capital and not from the profit. If it is from the profit, then it is called as drawings. If it is the withdrawal of capital, then it is known as capital only. Okay, you have to be careful with this because the question can be this also, question can be on this also. Okay. So while calculating the interest on capital, If I talk of interest on capital, right, we won't consider these drawings, we'll consider this. Because if he is introducing a capital of 1 lakh and afterwards out of that capital of 1 lakh he has withdrawn a capital of 20,000, then he is left with a capital of 80,000 and interest will be paid on this 80,000 only, because 20,000 he has already withdrawn. Clear? So be careful with these two terms, drawings against profit and drawings against capital. So you can write this down. This is a very simple case I have discussed today of interest on drawings where the amount is not fixed and the interval is not fixed. Clear? So we have two methods for that, simple and the product method. Simple method, calculate interest on drawings on individual drawings, right? Product method says multiply the amount of drawings with the period for which that amount is going to be used and then total of the product. On that total we will calculate the interest for 1 month. Clear? Then the terms drawings against profit and drawings against capital. Drawings against profit is drawings against capital is you are taking some amount out of your own capital, so that is capital only. The capital will reduce. Clear?